Dividend investors, bonjour, this is Mike Yahoo, founder of Dividend Stocks and passionate investor. Today I'm taking a quick tour on the Dividend Stock Cards. The purpose of this video is to show you each section, what to expect, how to read it, what metrics mean, so it will be an important guide for you to analyze those stock cards. So here we go. When we start on the home page, you will see that you have the option either of selecting US stock cards or Canadian stock cards. By clicking on it, you will access our complete stock card library. This means that you have access to over 400 stock cards, and the purpose is not to get to 500 or 1,000, so you get overwhelmed by a bunch of information. In fact, every 6 months, we clear up some stocks that are either weak or poorly rated, or we just found better options throughout the in the same industry. So the purpose is always to keep this list as short as possible and make sure that you have the best stocks right away in front of you. If you want to play around with metrics, you can download them right here. So you click right there and there will be an automatically pop up where you can download the Excel spreadsheet, play around with the numbers. But today we are moving forward and we're going to look at a specific stock card. I've selected Broadcom, no specific reason over there, just because I think it was a good one to look at. The first section is obviously company in a nutshell, where you will have a quick summary in 3 points of what the company is about or what is important to understand about it. And you can also download the PDF format of the stock card. PDF format is 2 pages downloadable analysis where you have limitation in terms of metrics because metrics are updated weekly on the web page and every 6 months on the PDF. So the text is the same, but we prefer to have more updated, more up-to-date metrics. As you can see, this one was last reviewed on April 13th. Every 6 months, they are being reviewed. If they pass the test of being relevant, we keep them on the website and then we keep updating them. And if they're not, we'll just delete them and wait if there's more requests from other members. Other reason why we would take one off is if not enough DSR Pro members have it in their portfolio. So if we think that it's an okay company and then we have like 3 or 4 members have it on their portfolio out of like, I don't know, more than 500 DSR Pro members right now. Well, it doesn't really make sense for us to spend time and energy to follow a stock that is not quite popular and that, in our opinion, is just doing an okay job. You will find the DSR Pro rating and the dividend safety score right here. Those metrics are updated quarterly. After every earnings season, we look at each stocks and then we update their rating accordingly. Then after that, you have the DDM valuation. So this is an upside or downside potential according to the dividend discount model. We'll get there in a second. So we have a complete valuation section in this stock card. You obviously have dividend yield and dividend growth since 2010, meaning that Broadcom has increased its dividend yearly, never missed a payment, never missed an increase since 2010, and the dividend frequency is quarterly, so it means that you will receive your dividend every 3 months, so 4 times a year. So if we go down right here, and I'm gonna just there you go with my screen, it's a little better. So first section here is the business model. Basically, we're telling you exactly what Broadcom does, and what you will have right here is the metrics in regards to the company in general. So we have the stock price, which is updated daily from Google Finance, the sector, technology, the beta. Beta is telling you if the stock is moving more or less compared to the stock market. So a beta of 1.15 will tell you that when the market is up by 1%, chances are that Broadcom is up by 1.15. So it will go slightly, it will have like slightly higher, bigger movement than the stock market. So when the stock market goes down, applies the same thing. Then we have expected earning dates and dividend ex-dividend next ex-dividend date, sorry. Those are approximation taken from Y chart. Sometimes there's a few days of delay, and when the date is not available, when the payment has, like for example, the last dividend payment has been paid, so there's no next ex-dividend paid dividend date yet, we'll have NA right here. So this just gives you when to expect new earnings if you want to go on the investor's website to get the information right away. And same thing if you're considering selling the stock but you would like to cash a last dividend before doing it, there you have the ex-dividend date for that. Next section is the investment thesis. So the investment thesis is basically all the good reason to hold the stocks or the bad reason to sell it. Basically what we're doing here is we're telling you what we think about the company, what the growth vectors are or the potential risk, and if we like it or not. So the investment thesis will likely be in line with our pro and dividend safety score right there. So if we go a little bit lower, we will have the dividend triangle. The dividend triangle is basically the basis of any of our research. This is not the only thing we look at, but this is the first thing that we look at in terms of metrics. So basically what we show you is the trend over the past 5 years for revenue growth, earning growth, and dividend growth. When you think about it, it's quite clear. If a company is a leader in their business market, they have growth vectors, they expected to grow by acquisition or by innovation or other means, organic growth, for example, you'll have growing revenues. Then what you're looking for is you want to have companies that are able to grow their revenue, but also their earnings, because you want companies making more money quarter after quarter or year after year. And finally, if you have management that is confident enough in the business model that it's able to increase its dividend at the same pace, then you have what we call a perfect triangle. So right here what you have is 5 years dividend growth rate, earnings, and dividend. Those are annualized growth rate. It seems a lot, but keep in mind that 5 years ago Broadcom paid roughly, I think was like 42 cents a share. Now it's at 3.25, so it's a huge increase. So you will rarely see such huge numbers, but this is telling you that the company is growing very fast. If you go back in the business model and the investment thesis, you will find out that Broadcom applies a growth by acquisition strategy. So it's only normal that you see lots of growth over here in terms of revenue and earnings. Now, very important, now that you get hype about the stocks and then you're all excited, it's time to read the potential risk. Potential risk is all the things that could go wrong. It doesn't mean that it will go wrong right away, but we only highlight what could possibly hurt the business model or growth over time. Then you have a bunch of metrics. The first one is debt on equity. So this is telling you if the company is financing their project and their activities from debt or from equity. A high debt to equity ratio will tell you that the company is using a lot of leverage to finance its activities. So the more debt, the higher the ratio, the more debt holder claims on assets there is. So basically it's a little bit more dangerous. So right now what we see is that the company has twice the amount of debt for the amount of equity, which is kind of normal because they're doing a lot of acquisition. The next one is financial debt to EBITDA. So basically, this is the financial debt. This is the long-term debt divided by the earnings before interest, depreciation, amortization, and taxation. So this is telling you the company has 4 times its earnings in debts, which is not the end of the world. Obviously, we would like to have a lower year ratio here, but keep in mind that if a company has a very low ratio there, it also means it may not use enough leverage to support growth going further. So it's more to give you an idea of which kind of company, what is the style of the business in terms of using leverage or not. Now moving on to the current ratio, which is quite interesting, especially when you're in a moment of recession. At the time of recording this video, we're in the middle of the pandemic of the coronavirus. So you want to make sure that the company has enough short-term assets to cover short-term liabilities. So in this case, we have twice the amount of assets to pay short-term liabilities. This is pretty good. In an ideal world, we would like to have a ratio that is at least least 2. More is even better, but at least 2, you know that the company has enough money to keep the business running regardless if there's a problem or not. Last one is the free cash flow. So this is quarterly, so you can see that Broadcom is definitely a cash printing machine with $3 billion in their latest quarter generated in free cash flow. Keep in mind that depending on the quarter, this number can fluctuate a lot depending if the company is using their cash flow for a specific project. We often use the expression CapEx for capital expenditure. So it's important to dig a little bit further when you see that there's something wrong over there. This is your invitation to go into the website, investor relation website for the company. You look out at the latest quarterly earnings, and then you'll get the press release. And from there, you'll get all the information that explains those weird numbers or numbers that don't make sense for you. Next section is the dividend growth perspective. And this is very important, especially this is one of the reasons why I decided to pick Broadcom to make an example of it. When you look at the dividend, you see 3.25, so $3.25 quarterly dividend, which is pretty good. And then you look at the payout ratio, which doesn't really make sense, right? This company has been increasing its dividends since 2010 and shows strong growth. But yet, the payout ratio is nearly 200%, which is quite scary, actually. But when you read the section right here, you'll see right there the payout ratio seems quite hectic and out of norm, over 100% many times. This is caused by multiple charges related to acquisition and other events. If you look at the quarterly earnings, what you will find, for example, at the time of the recording on this one, latest earnings shows the company recorded $1.5 billion in amortization on recent acquisitions. So basically, when you use the non-GAAP EPS, you will have a decent payout ratio. But when you use the classic GAAP EPS, this is where you have a ridiculous payout ratio. But then you can look at the cash payout ratio, which is 48%. Well, let's say for 50%. It tells you that, and the cash payout ratio is basically the dividend divided by the free cash flow. So this is where you can see, oh, the company generated $3 billion in cash flow, so it has a low payout cash flow. It totally makes sense. This is where it's important to read what is here, what is explained right there. It will often tell you if the numbers doesn't match. It will tell you if it makes sense or not and provide further explanation. Other case where you'll find this is with REITs, because REITs don't work with payout ratio and cash payout ratio. They will work with funds from operation and adjusted funds from operation, so for FFO or AFFO payout ratio, which is completely different. This will be explained in the dividend perspective. Then the last section of the stock card is very important to many investors. For me, not too much, I'll be honest. I have done other video about the valuation section. For me, it's a lot more important to get a company that has strong growth vectors and a very strong dividend triangle than the stock valuation, because it's just as good as your assumption. The valuation table that you see right here is the dividend discount model. We use a two-step, meaning that we have a first growth rate for the first 10 years, reflecting the current situation of the company. So we use 7% right now. And then we usually select a lower number for the terminal growth rate. So keep in mind the dividend discount model will give you the value of a stock based on its ability to pay dividend. So it will not really work for lower yield, higher growth perspective stocks, because their value as a dividend payer is a lot smaller than their value as an overall stocks that will grow in the future, right? The other thing that you will see here is the use of the discount rate. So depending on stocks, we use either a 9, 10, or 11 discount rate, and we publish the entire chart right here just to show you how sensible the DDM methods is, depending on which kind of number you're using. So the intrinsic value in this case would be 319. But if you use a discount rate of 9%, meaning that you expect 9% return on your investment, then the intrinsic value becomes 400. On the other side, if you expect 11% return on your investment, then the intrinsic value is at 264. So there's a huge difference between a discount rate of 9, 10, 11. Same thing if we would have used other numbers right here for the expected dividend growth rate. So just take this valuation with a grain of salt, but at least it gives you an idea of where you should use your money. I like to use the DDM model to compare a few companies within the same sector. So I try to use similar numbers for the growth rate and for the discount rate, and then it gives me a good idea of which one seems to be undervalued compared to the others. We also added a few other valuation methodology here. So you have the market cap, so 127 billion, which is a blue chip, a big capitalization company. PE ratio and forward PE ratio, as you can see here, it all makes sense. You have a super high price earning ratio right now at 56, but keep in mind earnings were lower in the last quarter because of amortization used on acquisition. So then again, this is why you have a very high PE ratio right here and a forward PE ratio of 13, which totally makes a lot more sense. So this means that in the next 12 months, we should get a PE ratio of 13. So earnings should get back in order, so without those crazy charges in amortization, and then you have a valuation that makes a little bit more sense, and then price to book ratio that you have right there. As mentioned earlier, you have all the data are coming either from YChart or Google Finance. We update all the black boxes every week. Google Finance is for the stock price. This is being updated daily. The dividend triangle chart, so this image is updated every 6 months, as long as all the text and the PDF in it, and the ratings are updated quarterly after each earnings season. If you have any questions about how to analyze a stock or to look at the stock cards, please let me know. Use the contact section right here. Send us an email. We usually are pretty fast on answering emails. You can count on the same business day or 12 hours working days. So basically, if you send me something at 5 p.m. On a business day, the next morning you should have an answer. I hope that this video has helped you to understand how to use and to read stock cards. And until my next video, stay invested. Cheers.